Welcome to this session on financing nature-based solutions, delivering money when and to where it matters. I'm Ben Caldecott. I'm director of something called the Oxford Sustainable Finance Group here at the university and also director of the UK Centre for Greening Finance and Investment. It's a great pleasure to be here to be chairing this session on finance and investment. We need to get much, much better at channeling capital into solutions to nature recovery, into nature-based solutions, and we need to be able to do that at a global scale. The Paulson Institute estimated that in 2019, financial flows into global biodiversity conservation was between about 120 and 140 billion US dollars. They estimated that to reverse the decline in biodiversity by 2030, globally we would need to spend between 720 and 970 billion each year over the next 10 years. And that puts the financing gap at something like 600 to 800 billion per year. That was in an average of 700 billion per year, sorry. Now that was in 2019, and presumably that's much higher now because time has elapsed. We haven't closed that gap in the last period. We've had COVID as well, and there's now a commodity price boom. So I haven't seen the numbers, but I'm assuming that I've got a strong, I think my hypothesis, I'd love to work with somebody to figure this out, is that financial flows into nature recovery have actually declined significantly because of COVID-19, particularly in some of the most biodiverse parts of the world. Significant fiscal impacts, significant declines in ecotourism, and I mentioned the commodity prices, very significant change there, making it more attractive to liquidate the natural the habitats and the ecosystems that we've been talking about over this conference so far. So what are the necessary conditions required to mobilize capital at the necessary scale and pace? What barriers do we need to overcome, even if those necessary conditions are met? What lessons can we learn from different experiences we've had internationally? And what transformative collaborations can we create or bring to bear to make the progress that's necessary over a very short period of time? So these are some of the big questions we're going to try and discuss today in this session. We have four wonderful speakers who are going to help us to do this. We also have you. It's a 2-hour session. I'm expecting and hoping for lots of audience participation and interaction, so please do think about the questions you want to ask, the points you want to make. There should be a safe space for a collaborative conversation about these different issues, and I'm hoping that it's also educational as well. I'm sure we'll be able to learn a lot from each other. And what I'm hoping also is that this is one of many steps that we need to take to enable, support the translation often that needs to happen between the finance and investment community and those working directly in on conservation and ecology and biodiversity. So what I've asked each of the speakers to do is to start with a 12-15-minute talk. There'll then be 5 minutes after each talk for very brief Q&A on points of information on their talk. And then we'll come back together and have a panel discussion with lots of participation from you. Two of our speakers are going to be joining us online. I'm not going to introduce each of the speakers because they can introduce themselves, but we're going to start with Lorenzo from Lombard Odier. We're then going to go to Abyd from Bank of America. We'll then hear from Rhian-Mari, who is CEO of the Green Finance Institute, and then Dora from the World Bank. So, Lorenzo, you're first.
It's wonderful to be here. My name is Lorenzo Bernasconi. I'm head of climate and environmental solutions at Lombard Odier, which is a Swiss investment firm. And what I thought I would speak about today is just give you a view on kind of where we see the opportunity, the promises around nature-based solutions, particularly as we're thinking about, I think the critical factor and what's distinctive about today's meeting is really thinking about local communities and indigenous communities that are so core to supporting the effort. And we, I think, see that as key to the solution. So I wanted to give you a view on how we see it, but also some of the barriers that we still see in the way of actually realizing that potential. I do realize this is a academic conference, not a investor conference, but this is important just to, I think, give a bit of a sense of who we are and how we are approaching this from an asset management perspective. So Lombard Odier, key to kind of the work we're doing is really sustainability. And that's really what's kind of quite distinct about the approach, and really from the top down, the idea of us doing this with environmental and social integrity is key. And we're very proud to also be partners with Oxford University and with Ben and his team and Natalie to be able to support some of the really cutting edge research that's being done at the university around sustainable finance and NbS solutions more broadly. We're also members of the Circular Alliance for Bioeconomy, which Mark Palahi spoke about this morning. So being part of this kind of journey through these different associations for some time. And linked to this, core to the investment thesis of the overall group is the idea that we are driving towards a sustainability revolution that is happening, needs to happen, and needs to be accelerated. And so we're really at the forefront of creating investment products for clients that really have this at the core. And kind of the way in which we've codified this is this idea of moving from a wild to a click economy. So wild being an economy that is wasteful, idle, lopsided, and dirty, and one that is moving towards one that's circular, lean, inclusive, and clean. And that really underscores all of the kind of investment products and advice that we provide. And underpinning this is really the idea of planetary boundaries, which is kind of all of the work we're doing is looking to be backed by the best science, and this is in a way the organizing framework for a lot of the work. And as you see here, obviously, questions around climate change, forest degradation, biodiversity loss, the use of water, these are all key planetary boundaries that we're reaching, and really is what underscores also our interest around nature-based solutions. So how are we thinking about it? This is a picture of Mato Grosso, which I think, in my view, speaks to a little bit the North Star of the possibility that NbS can deliver, and how it is that we want to ultimately be participating in this as an investment opportunity. Mato Grosso, as you can see, is a very large state in Brazil. It's about the size of France and Germany combined. And it's an agricultural powerhouse. It's the biggest exporter or producer of beef, soy, and corn in Brazil, and has a really interesting story, because I think now, in a way, it's a model for how I think we can see both a sustainable development and economic development coming side by side. And it's a really fascinating story of how it is that they got there, which is shown in this next slide. If it's going to work. There we go. So this is an amazing story of how Mato Grosso was able to reduce deforestation by 90% between 2002 and 2012. Now we're about a reduction of 84%. At the same time, as you can see, actually cattle production as well as soy production continued going up. So they were able to decouple deforestation from economic development, which is absolutely key. And even now, it's at about 85% reduction from its height. And how did they do this? It was really through the involvement and partnership with the Norwegian government, with the German government, and there were incentive payments that were made where the government really engaged in three things. On the one hand, they really started tackling illegal land grabs and the burning of the forests. Second, they empowered local communities and indigenous groups to defend their territories. And three, they worked with the agricultural sector and traders to think about more sustainable pathways towards agricultural production. And I think this is a very, as I mentioned, a very inspiring story. If you think about it, at the beginning of the journey, they were the 10th largest polluter in the world. By the end of it, they were down to the 77th. And all of this happened in a very short period of time. And as you can see, there hasn't been the reversals that we would expect, even under the current administration, which, as we know, hasn't necessarily been favorable to the cause. So how do we think about getting there. For us, we are looking at this, and I think we've mentioned this earlier in the conference, it's really thinking about getting to scale through a jurisdictional approach. And what makes this interesting from our perspective is twofold. On the one hand, is that when you're working at the jurisdictional level, you're forced to work with governments that are key, as well as indigenous communities, I should add, that are key to implementing the policies that you need to actually be successful. And whether it be, in this case, we're talking about ending deforestation, but more generally in driving the policy measures you need for successful investments into NbS. You need that policy framework. Without it, you're not going to actually ever get long-term investment. And secondly, a larger scale jurisdictional approach deals with a lot of the quality issues that you may have around permanence, leakage, additionality. There are easier ways to measure that, which we can get into, but that's another attraction from it in terms of just the environmental and social integrity of these efforts. I should say, this is not at the expense of projects per se, but I think this is the North Star of where we need to go. And back to Ben's original question of what do you think are some of the core elements that need to be in place for large-scale investment to flow? It's making sure that the policy environment is there. And as that translates in NbS talk, I see that as really the drive towards a more jurisdictional approach. So where are we? As some of you may know, a recent development has been the launch of the LEAF Coalition, which in Glasgow last year raised $1 billion for 100 million tons of forward commitments by a set of corporate buyers and donors for jurisdictional red carbon credits. And there was an organization called Emergent that was set up to be the intermediary between, on the one hand, these buyers, and on the other hand, forest countries. I had the pleasure of being a part of that journey. In a previous life, I was at the Rockefeller Foundation, was the first funder of Emergent. Followed that journey for about 6 years. The initial idea was about 7 years old, but the 6 years, and served as the board, the founding board chair of Emergent. So I've got a bit of a sense of the complexities of doing this. But the goal of this as an initiative was to say, look, if we're going to get investments to flow, what we need to do is have the strong demand signal to be able to actually then incentivize countries to start thinking about taking NbS seriously and driving towards that jurisdictional approach we spoke about. And if you think about it, it was in many ways very exciting to see the response. We got over 30 applications covering, 500 million hectares, which was larger than the size of the European Union, which showed that there's real interest in this from countries to think about this as a potential way of complementing or driving their development model to one that is taking nature at the heart of it. What made this possible were these I think, three key elements. One was the fact that, now we have ways of properly measuring impact on the ground. And this is, largely thanks to the new technology, machine learning solutions that we have, which is making this a very exciting time to be thinking more broadly and bigger about the NbS opportunity. Second, there was a high quality standard that was set up specifically for thinking about creating carbon credits at this jurisdictional scale, taking into consideration also important social safeguards, including the involvement of indigenous communities and local communities. It had the right kind of buffers. It was also one that is looking to increase government ambition over time to really drive as quickly as we can to ending deforestation by 2030. And thirdly, very, very importantly here, this is an area where obviously transacting directly with some of these forest countries is complicated, so you needed to have an efficient way for corporates to be able to transact and actually get in and participate in this market, which is absolutely key. A second, I think, important condition for really driving private investment at scale into the space. So I think what's exciting here is that we have the beginnings, and I should say this is just the very, very beginnings of a market, but there's strong signals of interest, particularly on the supply side, of saying, look, this is something we're interested in doing. There's an interest in getting to that scale. But the challenge that I think we still see, and one that is important for us to think about, is really on the supply side. And If I look at it really, and I were to just, break the problem down into its to simplest constituent parts. The one hand, it's like if it's any investment, you want to know whether if you're putting money in, can whatever the organization or the company you're putting money in, can they execute on the plan? So the one is, we don't see really there's on the ground capacity, not just at the government level, but whether that be corporates, companies supporting a jurisdictional approach, or even for that matter, the NGO community. That lack of capacity on the ground is a really, really big hindrance. Two, as you think about this from an investment perspective, you're going long-term into some of these markets, the risks that you have are kind of disproportionate to the returns. And I think that's very important to keep in mind. I mean, the credit enhancement is one that really allows you to think about those, worst case scenarios. There's a change in government, whatever the case may be. As an investor, you need to be absolutely sure that there's some kind of risk mitigation that's in place. And I think that's very important also to think about in terms of the social component that I think is of interest to us and many in the room, because the riskier it is, the higher the returns. And so if you're looking at benefit sharing with communities, the credit enhancement not only brings the investment in, but allows you to also do it in a more responsible way that works. And we've seen many cowboys going into difficult to serve markets, and they're taking very, very big returns, but we don't think that that's actually a scalable approach, nor one that we want to engage with. And third is one around stronger signals around long-term demand. In any market, of course, in any investment, you want to make sure that there's actually going to be a way of selling that product. And in this case, I think there's still question marks, as this is a very fast evolving market to think about, is there really going to be the demand at scale for, in this case, jurisdictional red credits? But I think that lesson is true across other NbS type solutions. And it's extremely important to do whatever we can, I think, for these high priority subsectors to create those robust demand signals. So some suggestions here really for discussion as to how things we can think about overcoming some of this. I think one is a real step change in philanthropic and government support for this initial on-the-ground capacity building. And I'm excited to see that there's some movement in that direction, but we really need to step that up, several times over to really have the impact that we need. Secondly, I mean, there's a lot of interest, and I think we'll speak about this around the blended finance opportunity. But the challenge is not just that the scale and the amount of financing is limited. What really kind of holds people back is the time that it takes to be able to access that capital. And I'll get to that in a minute. But making it easier for us to engage and actually partner, as I mentioned, the emergent story took 8 years to realize, and we simply do not have that time if we're going to actually tackle this challenge by 2030, which is when we need to do it. The money has to go now, and we have a really amazing opportunity because there's unprecedented interest in actually moving on the private side. But when the details, the devil's in the details, and when it comes down to it, what we see time and time again is the need for that kind of support. Thirdly, I think that there's an opportunity here for us to think also more creatively around new, more scalable business models. I would include into that, new approaches to insetting that are just emerging. I think that, more efficient agricultural practices, that's key to this. As I mentioned before, if you're going to reduce the amount of land made available to agriculture, you'll need to find ways of also improving the efficiency of agricultural production. There's, I think, a whole set of opportunities on that side of the equation as well. I would add to this as well that I think we need to think beyond just the carbon markets, or at least see if there's ways of adapting the carbon markets also for addressing some market failures, such as, compensating governments for standing forests that may not be imminently in danger. That's a very, HFLD countries, that's a really kind of core challenge that we need to address, because those virgin forests are absolutely critical for us achieving net zero and biodiversity goals. And then I think finally, just to add a little bit of potentially some controversy to the story, I think we need a little bit clearer, and if I dare say, better guidance, particularly to corporates. And if I even might, mention the Oxford principles that do a very good job, but in the way that they're potentially positioned, they have absolutely, with SBTI, detracted corporate interest from some of these really, really high impact, mission critical carbon credits, like linked to reduced deforestation. And I think it's not necessarily, it's as much a communication challenge, but it's to recognize that corporates have very, very little capacity to think about these things. And the minute that a certain guidance comes out, that's what they go with. And I think the challenge we might see is that what we're driving towards is a net zero goal 2050, but by that point we've missed the opportunity to also address some of these very large and critical NbS opportunities. So with that, I'm done and look forward to the conversation. Thank you all very much.
So we've got a few minutes for some points of information on Lorenzo's very good talk. Yes, and if you want to, there's a microphone coming, if you could just say who you are and where you're based.
Yes, thank you. My name is Alex. I'm based at the Nature-Based Solutions Initiative, and I just wanted to, thank you for a great presentation. I have several points I want to mention, but I'll be quick. The first point is if you could just clarify what you mean by corporate interests have been detracted from high impact credits, because, and then you said they have little capacity to think about this, but they certainly have the resources to think about this in terms of finance. And then second, I wanted to challenge a little bit the decoupling graph you showed. I'm by no means an expert on this. Our colleague Aline would certainly be able to comment, but my understanding is that this sort of decoupling does not occur when you account for leakage effects, and as a whole, it depends on how you define development, and that's an important point. But as a whole, there is no evidence whatsoever of absolute decoupling when it comes to material and ecological footprint. So I thought I would hand it over to you to clarify that a little bit and to respond to the first point in relation to what you mean in terms about corporate responsibility and how they've been detracted from high impact credits. Thanks.
Okay, well, given that it was two, do you want to respond?
Yeah, sure. So I think that very live examples of getting some of these corporates, for instance, to be buying the credits that were linked to the LEAF coalition, which were linked to reduce deforestation. What you see there is, look, these are relatively large commitments. At the end of the day, there is one sustainability lead potentially that is, in many cases, at the job within the last 2 years. They're dealing with a host of different things. And when they're going to go to their CEO and say, look, we need to put money behind this, and they ask, what is the strategic business rationale for doing this? And you say, well, it doesn't actually count towards net zero. It 100% detracts. In many of the cases that we had, it was actually calls directly to the CEO to say, you have to do this, from another CEO, because they said, the scientific importance of this, the ecological importance of doing this is key. Who cares what your sustainability lead says, do it. And that happened, and we've seen others that say, we're not doing it because it doesn't count towards our SBTi net zero targets. So the subtlety isn't there. And I think that's what's really important. So whether it's introducing interim goals or other elements to help guide and make sure we don't miss this opportunity, in my view, is mission critical, because it's unclear really, and this is true not just in avoided deforestation, but I think it's the best example, that there are other areas that may be reductions, but because it's not a removal, there's not going to be the interest. I think on the other point, I can't speak to the kind of overall, details of the Mato Grosso example per se. But what I think is important is that that's what we need to aim for, is this idea of finding a different pathway for developing countries to really put nature at the core. And whether the Mato Grosso may have resulted in leakage, it's not something that, to be fair with you, I've looked into. But what I think it does say is, look, in this case, we're talking about a massive land mass. They have been able to, in this case, increase some of their core commodities, which is in this case, soy and beef, massively reducing deforestation in ways that still now remain. And that is the kind of goal that we think is really the pathway towards making this real, because from that, all of the things that Mark Palahi spoke about today, the circular bioeconomy, that then takes shape. But you need to kind of shift it away from the current models in an environment which is extremely tough. I mean, all developing countries post-COVID are massively in debt. Commodity prices are through the roof. It is a really hard proposition, but we need to go at scale, and we need to do it in a way that I think makes the incentive there to keep these freestanding as opposed to cutting them down.
So Lorenzo, just quickly on the Oxford offsetting principles, which you mentioned before. I need to speak to Natalie and some of the other co-authors, but I think we are thinking about doing a revision and possibly having a look at some of the language around nature-based solutions. But I think we've heard this from others that we're perhaps a bit too harsh on those forms of removal. But there is a tension that we will come back to, which is that a lot of avoided emissions offsets could flood the market and affect the ability to bring forward other forms of removal, right? And so getting that balance right and that nuance right is really, really key. We had another question just over there.
Hi, James Hargreaves, a master's student at King's College London, looking at financing nature-based solutions. My question was about the second enabler that you talked about, which was easier, faster access to funds. And I just wondered whether you could maybe expand on that a little bit, particularly when we look at beyond corporates as private sources of finance to pension funds and insurance funds, and perhaps onto the less specialist investors.
As I see it, you've got three types of investors going into this. You've got the corporates. You will have then a lot of the trading houses that are going into it to do the scale. Then you will have limited amounts, very limited of actual true institutional capital going into this. And I think in developed markets is a different story. I'm really talking now about the developing world, where is the big opportunities. And what I've been seeing is that even, everyone has their constraints, right? The corporates can't go really big, and the corporates tend not to want to commingle their capital. What they want to do is take this as a CSR project. So being able to do a big fund is hard to do that with just corporate money. It's doable, but it's a really long journey and it's difficult. You've got then the trading houses. The trading houses, they see a big opportunity, but their cost of capital is very high, and they just see this as one commodity versus others. So they need to be able to really get very high returns. And even they, who have massive resources, have a balance sheet, they have very, very strong teams, are not really taking long-term risks. They just can't, because of the kind of inherent risks that happen in investing in developing countries. And then the third category on the institutional side, well, you've got the family offices and so on, and you have smaller funds, but then really unlocking the pension funds. At the end of the day, there's a few challenges that come. One, they may not have an asset allocation for this because it's not big enough. So only few can say, okay, but there are some doing it, which is very exciting, and we're seeing that. And then I think that the way that many are going, is they're doing, agriculture, traditional agriculture plus, or forestry plus. That's the scalable story. When it comes to the things that maybe really are supporting the biodiversity equation, local communities, that leans more on the carbon, very hard, very, very hard. Or, restoration, very, very hard, because it's a lot of policy risk, and there is the cost, the opportunity cost, the transaction costs of getting the concessional finance you need to be able to do those deals is very high. So a few have cracked it, but by no means is it mainstream, and it won't get us to the trillions in the financing gap that we need to address, and that's the key that I see.
I've got one question from the online audience, and this is about the decoupling chart. Was the deforestation data showing annual deforestation or total deforested area?
Annual deforestation.
Okay, there you go. Any other quick points of information? Maybe time for one more. There. Sorry. I saw the guy first, sorry. Let's take two and after.
Hi there, I'm Francis Beechner from CMS. So my question was just on the supply side point that you touched on in terms of being able to trust the project developers that you are investing money in. How could that specific point be resolved further? Are you sort of envisaging a string of startup project developers springing up that are coming out of the finance industry, or like how does that need to be resolved specifically?
Okay, so trust and assurance, very important question. And then one last point of information here.
Thank you. It was just a quick point on one of your slides. You mentioned that one of the factors that's required is improved impact monitoring and improved impact data to show the outcomes of I suppose, the non-financial returns that you're getting from these investments. I was just wondering if you could expand on that a little bit, of what kind of metrics and data you'd like to see coming from these projects that aren't coming out at the moment.
So two very related questions, then another one from the audience online about the scale of LEAF. How much were the commitments? How big is it at the moment?
Maybe I can take that last one. So I think the official number now is $1 billion that was announced last year. But the number's gone up from that. So not sure when that's going to be announced, but it's well beyond $1 billion, which is extremely exciting. And just seeing the dynamics of that from the inside, it's just out of nowhere someone comes and says, well, we're putting in a few $100 million. You wouldn't have expected it. So it's definitely growing. On the first question, I think of building capacity. I think it's at two levels. On the one hand, one key element here is just even on the government side. As I mentioned before, I think that from an investment perspective, it's partly a policy question. You can always find, relatively good project developers, and that's great. But that's always going to be a limited amount of money, at least in the short run, that can be put to work. So in an ideal scenario, you've got the policy, you've got, at a national level, the MRV. They'll be able to actually do this at bigger scale. So that's a key element. Needless to say, capacity on the ground to do these projects is still a challenge on the project level or on the kind of more government level, which I think is one of the key elements. And a lot of that is going to, in an initial stage, I think, require patient capital / philanthropic capital as this is getting up and going. So, and not much money, I think, is flowing into that. And I think on the question of the KPIs that you're measuring, so my point was actually say the opposite in a way, is that like now we have an opportunity to measure things much more effectively than we ever could before. You can monitor in real time, obviously, where there's going to be challenges to, deforestation, and that's an opportunity. I think that. It's building on the machine learning and the satellite imagery that we have to be able to always do that with greater efficiency. And it depends. I think that the limitation that you have here on that is that you need the standards to catch up with the technology, and then that's going to be in a way driving it. Of course, there's going to be then additional benefits that you want to be able to speak to, that you want to be able to capture otherwise. But my hope is that we get more and more sophisticated, the standards catch up with this, and that you'll get ever more refined information and greater data.
Great stuff. Okay, well, we'll come back. There'll be other opportunities for questions and discussion. Thank you, Lorenzo. Abyd, over to you.
Yeah. I wanted to put some thoughts together on how we can get the financial sector to scale up its innovative focus on nature-based solutions. I think we've heard from Lorenzo, it's early days for the sector. And you might even be asking, why is Bank of America interested in this topic? So let me address that straight away. I think for us, the science has been very clear. We've heard great presentations yesterday on this. Global ecosystems approaching planetary tipping points, and this obviously has an impact on cash flows for companies, asset values, business models, and so this obviously is beginning to concern the financial sector, each different part of the financial value chain. with all these different types of risks that the financial sector is now beginning to learn about, there is obviously opportunity, and Ben has touched on the scale of this opportunity. If you think about the global funding gap for biodiversity, probably approaching $1 trillion per year now, given some of the factors you've mentioned, that's $1 trillion opportunity to create nature-positive outcomes. So, that's where I think we have to focus as well. But, there's always a but, the macroeconomic picture has changed very significantly, and we can't ignore that either. And that's obviously casting quite a negative outlook onto
Mm-hmm.
many the specific allocations of capital that companies and the financial sector are looking at. In simple terms, when you've got governments that are now facing difficult trade-offs between addressing inflation, addressing growth concerns, it has a very specific limitation for the amount of public capital that is likely to be focused on addressing, let's call them, the green cost premiums associated with delivering some of these nature-based solutions. And that has, I think, big consequences for what we're talking about here, because actually it means that public capital needs to be much more surgically deployed. And it needs to be much better at trying to attract the private flows of capital at scale. And, we've begun, I think, in the last couple of days, I've certainly heard little, I always get excited when I hear these little, de-risking private capital and capital mobilization. And, I think in the previous session, it was Celia who talked about the importance of this. So that's really, from our view at Bank of America, when we think about nature-based solutions, we think of it in the context of, well, we've made a $1.5 trillion commitment in sustainable finance by 2030. Nature-based solutions has, a role in that, and we'd like to explore, what specifically we can do to bring some of those opportunities to bear. Now, we're beginning to see KPIs, nature-related risk and opportunity KPIs filter into mainstream financial products. And by that I mean the boring stuff, loans, trade finance, supply chain finance. So, the integration of nature-related key performance indicators is now, it's quite common, I would say. But it hasn't been so common to see, the integration of KPIs generally is common, but it's still rare to see biodiversity and nature-related KPIs take their place. But it's encouraging that, we're beginning to see some of that. And, we heard earlier about the potential for the bond market to be another source of capital. This would be thematic-specific bonds, whether it's resilience or blue bonds. There's been some debt for nature swaps linked to bonds as well. But I think the big sort of scaling opportunities actually come from three areas, and that's really what I wanted to touch on in my remarks. The first is, can we get higher quality disclosure to the capital markets generally of nature-related risks and opportunity? We see that as pretty fundamental to delivering this shift in flows towards nature-positive outcomes. And we're actually part of the 34-member task force for nature-related financial disclosures. So that's one of the ways that we're trying to address that. The second is, and it's great that Lorenzo mentioned this already in the last presentation, can we see blended finance play a more critical role? And in fact, thanks to Stephanie's presentation yesterday, I now know that actually 78% of nature-based solutions, the potential exists in emerging market developing economies. I always knew it was the vast majority, but 78%. So that means that we need to do a much better job of attracting private capital into those, into those opportunities. So I'm going to touch on that. And then the third is really about the role of carbon credit markets. And I'll put into that category public grants as well, because we had the beginnings of a debate on the last session here yesterday, which is, and in fact, even just now, what's the role of the carbon credit markets? Should it be delivering REDD+, or should it be focusing on nature-based removals, or is that, carbon removals through nature-based solutions, or is that an artificial, distinction? So I'm going to touch on each of those with just a few minutes on each. So on TNFD, and I know Rhian-Mari is going to cover this as well. It's really fundamental. We don't have anything right now in the financial sector that reflects the full array of nature-related risks and opportunities, whether it's for corporates or whether it's for the constituents of the financial sector that is engaging with those different corporates. So it's fundamental so that we have a much better risk management framework. We have disclosure metrics which can help investors allocate capital in a way which addresses what is essentially an information gap in the market. The TNFD is on track to deliver its final reporting and disclosure framework by September 2023. So that's something you should be looking at. You may have already noticed that there's been a couple of so-called beta releases. There was one in March, and we had one just last week. So it's being built in a kind of innovative crowdsourcing way as well. So really encourage all of you as experts in the field to contribute your expertise to making sure that these are as scientifically robust as possible, keeping in mind, of course, that there is this tension between making, I guess, in simple terms, making the perfect the enemy of the good. But this needs to reflect, unlike the TCFD, it needs to reflect the location-specific risks and opportunities, and we've heard that very clearly throughout this couple of days as well. Okay, so that's TNFD. On blended finance, which I'm not sure if everyone's totally familiar with the concept, but basically, providers of philanthropic, public, and private capital working together in a collaborative fashion to build investment vehicles at scale that reflects essentially, heterogeneous positions on risk, return, and impact. I mean, that's the best way to, I think, capture it. So we at Bank of America, we've had, I like to call it the Petri dish. It's it's called a blended finance catalyst pool. It's a small pool of capital, and we've been using that to experiment in the space. We've completed 7 deals to date in areas like climate resilience and sustainable food systems, climate smart agriculture, as well as others less relevant for today, energy access being one of them. The experience that we've had has been mixed, and that's what I really want to come to in terms of specific recommendations. And why do I say mixed? The challenges are that the first loss capital is always in short supply. So the poor fund managers who are trying to build these blended finance structures are always running. Well, they used to run around, maybe not so much anymore, but running around the world trying to find the providers of this junior capital. In fact, Lorenzo, people used to call on you regularly at Rockefeller Foundation. Can you help us with identifying the junior, whatever it might be, debt or equity, to provide that first loss capital? So that's a challenge. I know Dora's on the line, and Dora, you'll have a chance to attack me later. But let me say, I think the multilateral development banks and some development finance institutions have sometimes, much to our surprise in the private sector, invested in these vehicles at a more senior level than we think appropriate. In other words, if everything goes wrong, they would be paid out sooner than those who are more junior in the capital stack. We don't think that's the role of public finance. We think it's the opposite. Public finance should be there to de-risk. So that's a topic I'm sure we'll come back to. But I'm happy to say that reform of MDBs seems to be on the international agenda. If it doesn't get squeezed out by other macroeconomic concerns. I think there are 3 specific recommendations I want to leave with you. First is MDBs should be using their balance sheets to develop instruments that can mitigate excessive risks faced by the private sector, and that might include the use of guarantees, which is an instrument they haven't used much to date. The second is they should be looking to co-invest with the private sector rather than competing with it and crowding it out. And then the third is there is potentially an opportunity to revise the risk framework, the risk appetites of the MDBs, so that private capital mobilization actually has a much bigger part of their mandate. And just to maybe quantify that, so today, when we talk about the multilateral development banks, the typical ratios of capital that they're leveraging from the private sector is actually on the order of about 1 to 1. But to get the sort of scale that Ben talked about, we need to move that to 1 to 10. That's a quantum change. All right, enough of that. Third is carbon markets. And I think, I can be brief here because, again, some of the points have been covered. First of all, the good news on the carbon markets is that we're seeing carbon pricing, both carbon taxes and revenue raised from emission allowance auctions increasing year on year, right? So it's I think it's 60% increase, so $84 billion. Some of that can be used by the public sector to help drive more investments into nature-based solutions. But that's not enough. One of the successes of COP26 was we finally got a rule book for the Paris Agreement, and that includes the unnamed, Article 6.4 mechanism, which looks an awful lot like the revival of the old clean development mechanism under the Kyoto Protocol. And the potential that this market mechanism, if I can call it that, has, is very significant to help countries cooperate through carbon markets to achieve their NDCs and more ambitious mitigation targets. So in simple terms, if we can learn, Ben asked us to say what have we learned from years gone by in the space. Well, we have to look at the CDM, what worked, what didn't work, and make sure that that gets incorporated rapidly into Article 6.4 so that that mechanism has a fast start and can be deployed in areas like nature-based solutions. I won't get into some of the technicalities of what countries could do. Perhaps we can save that for the panel discussion. But there is a lot. It's important for everyone to realize that unlike the CDM, Article 6.4, it's the countries, the host countries themselves, that have the ability to dictate whether a particular investment is in the language authorized or not authorized, and therefore whether it is going to count towards an NDC or whether it can be deemed Article 6.4 compliant, etc. But that's quickly going down a carbon credit rabbit hole. Until Article 6.4 is up and running, it's the voluntary market that will deliver most of the investments in nature climate solutions, and in fact, 38% of the carbon credit market last year was actually, I've got the number here somewhere. 38% was NCS reductions, so avoided deforestation, the red plus examples, and then another 8% for NCS removals. So removals definitely, the junior role at present when you look at NCS more generally, and that's primarily afforestation, reforestation, and a little bit of soil carbon projects. So, we need to make sure that we incorporate best practices in the safeguards. What have we learned from the voluntary market? What have we learned from some of the few examples that we've seen outside of the voluntary market? Lorenzo talked about buffer pools. There are different approaches to buffer pools in, for example, the Vera jurisdictional approach to REDD+. The Leaf Coalition, I think, has made a really strong contribution on buffer pools as well. Then we have, the idea of nesting project credits within those jurisdictional approaches. That's, again, best-in-class approach for governance of these types of projects. And, of course, layering together different revenue streams. We heard, some really good insights on that yesterday. It can't be just about carbon. That's woefully insufficient to make these projects stand up. So it has to be exploration of other payments for ecosystem services. It has to be other high-value, native forest projects. It's the combination of those revenue streams that is going to make this project more resilient. And then, whether you're talking about avoided deforestation, REDD+, or NCS removal type projects, it's absolutely fundamental to engage early and often with indigenous communities. One of the best practices that we've seen, whether it's in fact thematic bonds or projects that involve nature-based solutions, is that funds are distributed via community trusts. That's another best practice that I would say is something we can learn from. Let me leave my remarks there, but just say, TNFD, crucial for early adoption, blended finance, let's look at reform of MDB so that we get private capital mobilization at scale. And then the third is a fast start on Article 6.4, and then dynamic learning to incorporate what we've learned from the voluntary market. Thanks very much.
Okay, some very quick points of information. Yes. And then the lady at the back.
So, hi, thank you for your presentation. This is Emma van der Ven, Rabobank. I was wondering what your vision is for the Article 6.4 mechanism, and if you expect that to basically cannibalize on the voluntary carbon market, or do you think they're complementary? And then a follow-up question, how do you think the implementation of Article 6.4 mechanism will affect private finance into carbon projects? Do you think that will be positive or negative? Thank you very much.
Do I think respond directly to that now? Yeah.
Yeah, so I think, Article 6.4, I'm cautiously optimistic about its, what we've seen in terms of progress since Glasgow. We've got now an executive board that's been put together. The private sector is looking at what is the governance structure of this mechanism going to be. In terms of the interest level from the private sector, I think everyone is really looking to see, what will happen in terms of, for example, methodologies that will be incorporated by hopefully the COP27 meeting in Egypt. But the biggest challenge is, unlike with the CDM, we had regions sticking hands up and saying, okay, we'll be a demand center, right? The EU ETS decided to link with the Clean Development Mechanism. That immediately created a demand for 2 billion, I may have got the number slightly wrong, but approximately, 2 billion tons. Canada, Japan at the governmental level were buyers. And, what happened in the US, of course, is a different story. They were there for a brief moment and then it obviously fell away. So that's what we need to see. We need to see demand. In terms of cannibalization, I think there will be. I think we'll be in a situation where we get convergence eventually. But everything is really up to the countries themselves, and that's what makes it so intriguing. I think we'll see, countries basically become some of the, so some countries will choose a path where they authorize a lot of Article 6.4, and others will probably say, not interested. We'll go down a different road.
Great, okay. Next question.
Durham University and Utrecht University in the Netherlands as well. I really enjoyed both your presentations, and I would have loads of questions. But the first is, I had to miss a part of yesterday, and so I may well have just got the wrong end of the stick here. But you mentioned that the market for investing in nature-based solutions is much bigger in emerging economies than in the say the global north, just for want of a better phrase. But I'm intrigued by that if we take nature-based solutions to include the sort of ecosystem-based adaptation that we were talking about before. If you think about the amount of assets and capital in, say, Miami, New York, London, Hong Kong, and so on, you might have thought that there would be a market for the private sector to invest in a wider range of nature-based solutions. So I guess the question is the focus on carbon actually leading you to invest in the wrong places with nature-based solutions? And a slight follow-up to that is that I would argue this anyway, because I work a lot on cities, but it's much easier to get that sort of multiple streams of value that you're talking about in terms of all of the extra benefits of nature-based solutions when you've got large centres of population and multiple other kinds of issues that you're trying to tackle, which is usually an urban challenge rather than in forest areas. That we were talking about. So I'm just interested in how that's all playing out, which might actually be making the investment case harder than easier. Thanks.
Yeah, so and I think, you know, when I was reflecting on the number from, I think it was Stephanie's presentation, the 78%, I think that was in the context of ability to deliver towards the net zero target. So it was probably more of a carbon lens. So thanks for that. Yeah, you know, in terms of other revenue streams coming from, let's call it climate proofing, climate resilient infrastructure, absolutely. The bigger needs by far are in the northern countries. You know, my assumption has been all along that, you know, there won't be a challenge in attracting finance to those opportunities because it will be a must do. Yeah. Whether it happens or not is a different story, but yeah.
Okay, I think we will now move on to the next speaker. So Rhian-Mari, hopefully you can hear us and see us, and hopefully we'll be able to see you and hear you imminently. There we go. Cool. So thank you for joining us. Over to you.
I'd like to start by just giving a little bit of context. We've been talking about the importance of location specific, and I'd like to focus my remarks primarily on the UK. We commissioned environmental economics consultancy FTEC to assess the finance gap for the UK's key nature goals, and found at best there's a 44 billion financing gap over the next decade, and at worst a 97 billion gap. And that gap is the difference between government ambition, as stated, and the funds committed. If we could go to the next slide, picking up on some of the points that this isn't purely about carbon, this is about a range of interventions. And you see there the estimates for clean water, biodiversity, flood risk through natural flood management, bioresource efficiency, etc. And those gaps, some of these numbers don't appear to add up, and the reason for that being is sometimes government money is obviously allocated for the whole of the UK or for the GB, and it isn't allocated by country. And also when you go into each country, we were again seeing these sort of margins, which led us to, you know, quite that huge big gap between 44 and 97. But hopefully the picture is clear. There's a big gap and there's a huge opportunity for private finance. Brings me on to the next slide, which is as we look at that mission of mobilizing private finance, which both Lorenzo and Abyd have already spoken to, as we look at that mission, how do we mobilize private finance into nature positive activities and nature restoration? For the UK, we see 4 critical factors that need to be addressed. And obviously these are all intertwined. Number 1, as yet we still don't know what nature positive looks like. And in many cases, we have not determined what good looks like for nature restoration projects. Is it number of trees? Is it number of species? Is it certain species in certain locations? What data do buyers of flood management need, for example, that would give them confidence? Does every buyer have similar requirements? And what sort of standards do we need in place? At present in the UK, for example, we have many carbon codes being developed, adding to the woodland and the peatland code, and there's discussion around whether we need an overarching standard for all those codes, as well as codes for natural flood management and nutrient reduction. At the same time, the UK taxonomy is being developed, So we're also seeing a call for principles that guide nature-based investing now, while this process of data and standard development is taking place. In Scotland, we've already seen some interim principles on responsible investment in natural capital be published that aim to put some of these guardrails in place. Then secondly, there's still a lack of investment-ready projects, certainly here in the UK. We need to kick the tires on the models and the revenue streams that would work for buyers of these ecosystem services, as well as for the investors. In the UK, we have the Natural Environment Investment Readiness Fund, or the NERF, and that is providing grants for project developers to develop a business case from nature restoration activities or nature-based solutions. Full disclosure, the GFI is an advisor and an assessor on that fund. But we're pleased to report that some 75 projects in England are going through that journey of baselining and working with a code, identifying both buyers and sellers, and putting together the governance and legal structures that will result in revenue streams from their activity, be that through the sale of carbon sequestration or emissions avoidance, selling flood risk reduction, selling phosphate reduction, etc. In Scotland and Wales, there are discussions to establish similar grant programs. They're underway. And there are funds like this across the world. What is critical about the success of any of these pipeline development funds, however, is that the learnings are shared so that we start replicating and scaling up these solutions. Then thirdly, how do we ensure that the demand is there for these projects? We hear that there is a wall of money from investors waiting to go into projects, but on what terms? Are the margins high enough? What level of impact do they need to see from an investment? Do we need concessionary capital? And where is that going to come from? And one step before we even get to the investors, do we have enough interest from buyers of these ecosystem services? Are there sufficient demand drivers in place that will result in local councils, local businesses, water companies wanting to pay for natural flood management interventions, for example? In the UK, for example, a biodiversity net gain is being mandated for property developers, and that is leading to the creation of habitat banks. These are areas of nature restoration to meet that demand. But back to number one, is that really going to improve nature or just leave us in a net neutral nature position? And finally, the fourth pillar, what is the institutional architecture we need in place to meet our goals? Do we need regulation or policy changes? Here, the government is looking at how to develop new agricultural scheme to replace the common agricultural policy. And that's going to result in environmental gains from farmers that can also be stacked with private sector funding, for example. This kind of structural change is needed, but it is really, really challenging. If we could move to the next slide, please. So I just want to highlight that, there are barriers and bottlenecks and indeed some really innovative and hopefully smart ideas within each of these pillars. But for today, I'm just going to focus on pillars 2 and 3 and offer some real life examples. Next slide, please. So there are several solutions we see to supporting the development of a supply of projects. And as discussed, one of those is the pipeline development funding from the Natural Environment Investment Readiness Fund, and similarly the Natural Capital Financing Facility from the EIB. This slide shows the journey that most project developers, land managers, etc. will have to go through to develop a model that can attract upfront private finance or investment. Where we primarily see the bottleneck in the current set of projects are around steps 3, 4, and 5. As mentioned, we need to attract buyers for ecosystem services, and that means demonstrating material risk, but also having the data in place that will support buyers' demands. On larger landscape scale projects, which is really the goal, as I think Lorenzo highlighted, if we hope to meet investors' criterion, it's often the case that there will be multiple buyers in any deal. So some will be buying flood risk reduction, some will be buying the biodiversity uplift, some will be buying improved water quality, and some will be buying carbon. It's quite an effort to bring those together with multiple sellers, land managers, and developing this aggregation model and governance structure that works for everybody, and then putting the legal contracts in place. It's not impossible, but it is really time consuming at the moment as it's all very new, and it can take easily can take 18 months to work through. So we need to standardize this process a lot more and also provide as much shared learning about the models as they develop as possible. And as an aside, at the GFI, we have a site called GFI Hive. I would please encourage you to use that as a resource. And we are developing there an online toolkit that will help project managers move through these steps more quickly and that crowds in the learnings, based very much on real life data gathered from the fund. Next slide, please. So then in terms of increasing investor and buyer demand, for buyers, as mentioned, we need to create demand drivers, either artificially, as in the case of biodiversity net gain, or by establishing sectoral nature-based targets. Or we must do a much better job of evidencing the material risk of inaction. So we are hoping in the coming months in the UK to carry out work to quantify the exposure of UK financial institutions, also UK corporates, to nature-related dependencies. And that's going to shine a real light on the need for companies to start assessing that risk and investing in resilience, far greater pace and scale than we've seen to date. We also need sources of catalytic or concessional capital, as Abyd mentioned. In nearly all of the landscape scale restoration projects we see that are attracting commercial investment, there is some sort of guarantee or first loss tranche or impact tranche, and certainly some initial technical assistance or grant funding. Anecdotally, one wealth manager working on investable deals recently shared with us that a $20 million in first loss would have unlocked $1 billion in commercial capital for a large landscape scale restoration project they were looking at, but they just couldn't get that first loss tranche. At the same time, some projects are telling us that philanthropic capital is focused on funding nature restoration, when actually projects would prefer those funders to be using that funding to help them build models that can crowd in multiple times that amount in private finance. It can take a much longer time to build those models than a one and done restoration. And we hear that philanthropists, sensing the urgency as we all do, are currently focusing on these quicker fixes rather than building a scalable solution. And we genuinely call on them to rethink how they're deploying capital in those cases. And finally, again, we need as much learning, sharing as possible. As I mentioned, we set up GFI Hive to start showcasing examples of where and how private investment has got across the line in nature restoration or NbS projects, and also to provide investor-ready briefings on key opportunities in the UK. Next slide, please. So my final couple slides are about just highlighting some recent deals that have some innovative and interesting structures. So the first one is the Wyre River project. This is the first natural flood management project to be launched and delivered in England. And it's going to deliver more than 1,000 targeted measures to store, slow and intercept floodwater and prevent peak flow in a catchment in Lancashire in England. Beneficiaries of the reduced flood risk are paying for the interventions, and the project's community interest company has successfully raised a 9-year, £850,000 private loan facility to help fund the interventions. I'm going to go into some detail on this one because I often think we skim over some of the details, but if we are going to replicate some of these best practices, I think it's helpful for us to understand some detail. So do bear with me. The land managers, predominantly farmers, are responsible for hosting and maintaining the nature-based interventions that help to reduce flood risk. The obligation is in place, I mentioned, over a 9-year period, but there's a potential to extend this up to 50 years. The landowners or land managers, they receive an annual payment for hosting and, importantly, maintaining the interventions, with the potential for additional payments if certain biodiversity targets are achieved. So that project has developed a delivery plan of interventions over 70 hectares spread across more than 10 land holdings that include woodland creation, leaky dams, ponds and hedgerows. So to make sure these interventions are performing, the project has set up an adaptive management phase. This is a sort of initial 5-year period that allows the interventions to be altered according to their performance data. This phase then, that sort of precedes the start of outcomes-based payments from the beneficiaries in year 6, giving the project a period for altering to optimize performance during peak flow events as they happen. So the interventions themselves are installed by the Wyre Rivers Trust and its volunteers. The estimated costs of the project comprise £1.5 million of capital expenditure and £50,000 a year in running costs, including the land manager payments and maintenance costs of the interventions. So to cover these costs, the project identified beneficiaries to pay for the ecosystem services that the interventions are going to generate. The 5 buyers identified were Flood Re, United Utilities, the Environment Agency, Wyre Council, and Northwest Regional Flood and Coastal Committee. The buyers pay an annual project fee from year 1 to cover the lease payments to land managers. This is conditional on the implementation and maintenance of the interventions. The outcomes-based payments start in year 6, when the performance data gathered by the Wyre Rivers Trust verifies the delivery of the ecosystem services. It's a bit like social impact bonds or performance bonds in the way that would work. So natural flood management is the primary ecosystem service being delivered to these buyers. However, the intervention will also deliver other benefits like carbon sequestration from woodland planting, water quality improvements from reduced nutrient runoff, biodiversity improvements from the planting of woodlands and grasslands. So finally, to cover the £1.5 million of upfront capital expenditure, a mix of public and private funding was used. Grants of just over 627,000 were issued for tree planting and hedgerow creation from the Woodland Trust via the Northern Forest Grow Back Greener programme as part of DEFRA's Nature for Climate Fund. And these grants will be issued over the first 3 years of the project. Private investment for the remaining 850k was agreed in the form of a 9-year loan, and the loan is split into 2 facilities that bring various investors together. I've got 2 other examples, but I won't go into quite as much detail, so I hope you've been bearing with me on that one. Next slide, please. This is Trees for Life. So last year, Trees for Life launched another 9-year retail bond, and this was via Triodos's crowdfunding platform in order to invest in a rewilding centre that will help generate revenues. So Trees for Life is a small charity in the Highlands of Scotland. It's focused on rewilding, including reforestation through the planting of nearly 2 million native trees, as well as community support and development. The bond offering was launched last September. It had a £2 million target and closed less than 48 hours later with the target achieved. The minimum investment was £50 and the bond received an average investment of £4,800. The repayments are met via visitor fees, donations, and also the sale of carbon, and it offers a 6% return. And the reason I wanted to highlight this is it's an innovative model and shows the interest from retail investors if they can be harnessed. And then finally, I think this is my last slide. Thank you. This is an international case study, the Tropical Asia Forest Fund 2, or TAF2. This fund from New Forests, which had its first close in March of this year, with $120 million of commitments. It's going to invest in a diversified portfolio of sustainable forest plantation assets in Malaysia, Indonesia, Vietnam, Thailand, Laos, and Cambodia for end markets like timber, rubber, and carbon. It's going to manage those investments to implement 18 different impact activities, all closely aligned to the Paris Agreement and the UN Sustainable Development Goals, that are focusing on climate mitigation, biodiversity enhancement, as well as community development. The reason I think this one's an interesting deal, because instead of using a first loss tranche, there are instead 2 tranches, one providing 4 to 8% return for impact investors, and one paying 12 to 16% for the commercial investors. the impact investors are prepared to take a lower rate of return in order to see a larger impact from having commercial funding in the mix. So the impact tranche was $50 million, and New Forest co-created the fund structure with the David and Lucille Packard Foundation, which also invested in the impact tranche, as did some other investors, such as the Australian government. I'll leave it there, Ben. I was hoping just to provide some flavour of some of the innovative and creative solutions that are being brought to this solution, and also expand the conversation beyond carbon to demonstrate that this, activities are happening across a broad base of nature-based solutions. I hope that was interesting. Thank you.
Thanks so much, Rhian-Mari. So Rhian-Mari, lots of positive murmurings and lots of people taking pictures with their smartphones of your slides. So it's been very well received. So we've got, again, a couple of minutes for very quick points of information, conscious of time. Yep. Just ask one question and make it quick. And use the mic.
It's about de-risking, yeah, thank you. I just wanted to ask a question that might be a little bit provocative to the speakers, because de-risking was mentioned a few times. And I understand that in the investor space, there's a range of different types of investors, and it's a complex landscape. But why should the burden for de-risking be borne by the taxpayer? Thanks.
Okay, so that's not a point of information. That's a big question that I want us to come to in the discussion. Points of information, yes.
Yes, hello. Thank you for your presentation. I had a question on the demand in the market for impact results. Is there enough demand? So that was my question. And also, how do you value these impacts? 2 questions.
Okay, Rhian-Mari.
I'm really looking forward to answering the de-risking question, by the way. So looking forward to coming back to that.
We'll come back to it.
But specifically, thank you for the question on the demand. I think, and hopefully this came across in my prepared remarks, this is a pretty nascent market, and so it is all pretty immature in terms of both supply and demand. And as Abyd mentioned earlier, the work of large projects such as TNFD in particular is specifically designed to help us really elevate this dialogue both across corporates and across financial services, so that we're following in the footsteps of what we've seen work very effectively with carbon, TCFD and other projects, in that by elevating this to a boardroom dialogue, we actually start seeing some more urgency around both creating the mechanisms for both supply and demand. But to answer your question, no, there isn't sufficient. It's all too nascent at the moment.
Okay, I've got one question, well, 2 questions here actually from the online audience. So one is, do you have any urban or peri-urban examples from your case studies, Rhian-Mari? And then the other was, were there governance kind of bottlenecks that you spotted in the Wye Rivers case study? And if so, how were they overcome?
So on the urban, peri-urban, if it isn't up already on the GFI Hive, there is a really interesting case study about sustainable drainage. And so if it's not there, we'll hopefully get that up soon. But I would encourage, I can see some comments as well, people saying they found the case studies helpful. That's great. That is exactly why we set up the GFI Hive. And my colleague Helen Avery is responsible for all the podcasts and all the detailed case studies that we're putting up there. And we would absolutely welcome more, as well as encourage others to go through them. On the governance issues, that's again a very pertinent question, in that that's clearly an issue that we see on a number of transactions that effectively require a community of actors to make the transaction work. And those of us who are or have worked in financial services know that trying to do things by committee is never the most efficient way. But So without going into the detail of any particular governance issues on this transaction, that is one of the really big issues that we need to get over if we're going to start moving these transactions more quickly. It's how do we actually decide right from the outset on an agreed set of outcomes where all the parties around the table can quickly put their different agendas to one side and work far more collaboratively. And that's definitely a work in progress.
Okay, I think there was one hand up at the bottom, two. If you can make, sorry, right, you've already asked a question. Behind you, Prue, and the person next to you, very quickly.
Prue Addison from the Wildlife Trust. We've actually got one of the NERF projects going at the moment on habitat banking. And one thing that we're finding, particularly this is related to biodiversity net gain, there's so much uncertainty in what the regulation will bring next year. And we're finding that that's really holding things up in terms of being able to scope out buyers and investors. So I'm just wondering whether you're observing this in other case studies, the role of government in perhaps either speeding up or slowing down private investment in nature.
Could you pass it to the person next to you as well, and they can ask their question?
Hi, Rosa Mboache from Abyd Associates. So each nature market and ecosystem service has very different market entry requirement conditions to access finance. So for example, the additionality requirements for biodiversity net gain are very different from the additionality requirements of the Woodland Carbon Code. On top of that, we also have public funding going into projects where sometimes it covers the full cost of, for example, woodland creation and has additional maintenance payments and payments for the public goods that they are being delivered. So how are you ensuring that the projects are actually delivering additional ecosystem services and that the credits are indeed valuable to use as offsets and they're not just being duplicated?
Okay, Rhian-Mari, if you could hold off on that one, because that's another big one we'll come back to in the discussion. But Prue's question, particularly in relation to the UK government, I suspect I know the answer from you.
Well,
help or hindrance?
Today's a difficult day to ask for certainty from the UK government, but we'll skirt over that point. I'm in completely violent agreement with the questioner that the role of government is to provide the framework in this case so that we do have certainty. And we have such clear blueprints or green prints, if you like, from where we've done this well, or where we've seen it done well for the development of renewable energy, for example. And I often cite the success of offshore wind in the UK, where we have 40% of global installed offshore wind capacity around the British coastline. And there were very, very clear political signals that this, there was commitment to this industry and there was commitment to valuing those electrons. And in the same way, providing that framework that demonstrates there is commitment and that the credits and these new flows of revenue will have value for investors going forward. It's the core rule for any investor is having comfort over the actual values of cash flows going forward. So I'm in full agreement with that first comment. And yes, on the second one, additionality is a big topic and again, a meaty one for us all to get into.
Wonderful. Okay, thanks so much, Rhian-Mari. And you're going to stick around for a bit of a discussion later. So Dora, over to you. Thank you for joining us.
Thank you so much. It's such a privilege to be sitting on a panel like this with Lorenzo, with Abyd, with Rhian-Mari, and this, as you really probably pointed out in the beginning, this is, for me, quite an amount of cross-learning and cross-fertilization. I'm also awed by the participants in the audience, the questions that have come in, and very much looking forward to the conversation at the end of this. As pointed out, my name is Dora Cudjoe, but Abyd, I will not be wearing my World Bank hat today. So hopefully that somewhat circumvents the difficulty with the question around the MDBs. But in my capacity as the program coordinator for the climate investment funds, managing the stakeholder engagement portfolio, I will be bringing you perspectives on what we call the dedicated grant mechanism, a financing mechanism creatively designed under the leadership of indigenous peoples and local communities to advance their role in climate action and advance their role in overall sustainable forest management, biodiversity conservation, and for that matter, very much weighing in on that nature-based solutions discussion. I will be also bringing in the perspective of what are some of the, should I say, entry points on scaling up the critical role that indigenous peoples and local communities play in this space. Okay, so just to give you a quick insight, and I know, Ben, that we have very limited time and I'll keep it brief. Just to give you a quick insight, the Climate Investment Funds, as some of the audience and participants may know, was formed in 2008 under the leadership of the G8 and the G20 leaders for a financing vehicle that is able to readily support middle income and low income countries in advancing their low carbon development pathways, as well as climate resilient growth. And as a result, with currently about 10.5 billion multilateral climate funds, the Climate Investment Funds is supporting clean technology, clean energy, energy access, sustainable forest management, and climate resilience. Those are the four key programs that were initiated in 2008. We're using a very transparent and multi-sectoral approach to the formation of the SIF, as we call it. Indigenous people and local community leaders were part of the formation, and they saw the need to carve out dedicated resources that would meet the needs of IPLCs, for that matter, in their drive for climate action. So out of a $766 million targeting sustainable forest management, an $80 million grant was set aside, if I should say, to provide direct finance access to indigenous people and local communities to help them deploy, one, their traditional knowledge and technologies, their tested approaches to enhance biodiversity conservation and sustainable forest management. And I think it was quite right in that direction, in the sense that studies have shown that over 91% of lands that are managed by indigenous people and local communities are found to be in fair, or should I say good standards ecologically. And currently about 36% of the lands that have key biodiversity assets are found in lands managed by indigenous people and local communities. So if you're driving the need for nature-based solutions, then it's quite essential to give focus to the role that indigenous people and local communities play in this space. And that is why I think the SIF's intention back in 2008, 2010 still plays a critical role in this conversation. And that is why it's also extremely important to understand how to even further scale out such grant mechanisms that target indigenous people and local communities in their climate action. I also learned from our conversation, of course, I think Lorenzo, you quite mentioned it, the issue of partnership. Yes, from the climate investment standpoint, the funds are not implemented by the SIF. The SIF has this finance, or this, should I say, business model that allows us to partner directly with multilateral development banks in the likes of the World Bank, the IFC, Asian Development Bank, African Development Bank, EBRD, and then Inter-American Development Bank. These banks are the implementing arms of the SIF's climate, the SIF's both highly concessional and grants targeting the whole low carbon and climate resilient development paths. That model enables expedited delivery of actions and also tap into the environment and social safeguard standards that are tested in terms of addressing some of the risks with managing natural resources or managing biodiversity assets globally. Let me quickly point to key factors that has come out from this conversation: access to funds, ready access to funds, flexible funds that enable expedited action, which is critical in the climate fight. The dedicated grant mechanism, as I mentioned it, is designed in such a way to enhance the ability of IPLCs to prioritize their needs, both in conservation and then in their improved livelihoods, and then able to, under their own leadership, deliver these results on the ground, adopting monitoring and reporting mechanisms to be able to better track the results on the ground. Suffice to say that, yes, as I gave you some statistics at the beginning, indigenous people, local communities play significant roles, but when it comes to tracking of these results, monitoring these results, and capturing them in the bigger global climate finance architecture, you might realize that it's always relatively lesser. So that means that there's the need for that focused attention to better tracking, better monitoring, better reporting, addressing both the risks and the opportunities that they bring to the table. Of course, it's also critical to ensure that IPLCs are not in the game by themselves per se, but there's that space for partnership, there's that space for collaboration, there's that space for inclusivity, promoting the platforms for that, the ability to bring their lessons and experiences to showcase both at the national, but most importantly, at the global level where decisions around the limited climate funds and conservation financing are being made. I think it's also critical to note here that that whole governance system that enables IPLCs to be part of decisions around the prioritization of interventions in these key biodiversity areas is critical. And therefore, the DGM model provides that whole platform at the local, national, and regional, as well as the global level through the mechanism designed by the IPLCs themselves in the form of the DGM. Another point is that the whole decentralization of decision-making. And Abyd, I hope I'm attempting to address your question, but you know, the dedicated grant mechanism enables decisions to be made at the local or the grassroots level where the biodiversity assets are actually being protected. That makes it critical for that decentralized space to be well paid attention to. Then the one point that came out quite strongly is on capacity. And if I quote you wrong, Lorenzo, you'd have to forgive me, but I hope the conversation after this in the Q&A session would help out. But providing the needed tailored capacity to enable IPLCs take advantage of available resources to ensure that they are well equipped, both in the introduction of new and innovative approaches to climate solutions, but most importantly, they are able to have that climate, management of funds, which is critical, accessing funds and effectively managing and tracking the use of these funds. That is where the DGM model provides space for tailored capacity, both high-level technical capacity training, as well as solutions that would help unearth and further pool their lessons for showcasing on the global platform. So I think that whole governance, local level governance model, the decentralized mechanism for decision-making, and the continued capacity enablement as ingrained in the DGM model becomes one critical to pay attention to. Two quick things, and I will conclude so that we can spare some time for conversation. But I had the opportunity to sit on a platform on a similar session during the World Forestry Conservation Congress. And I was very pleased to hear from IPLC leaders, global IPLC leaders. And three key pointers that came out of that conversation is recognition. I'll call it the first R. Recognition for the role of IPLCs and advancing nature-based solutions, not just their siloed nature-based solutions, but integrating and mainstreaming the nature-based solutions in the broader climate management or climate action space. So that recognition becomes critical. To note that 91% of the lands are fairly managed and 36% of world biodiversity assets are in this space. And for the fact that they're doing that significant amount of work, that recognition becomes critical. The second point is on rights. Rights to the land tenure, right to natural capital, and then the right to financing, flexible, available financing to help them scale up and then mainstream their interventions with a broader conventional approaches to climate solutions. And the last point is on, so I mentioned rights, mentioned recognition, and I think the third, give me a second, let me pull my third point because I think it's a critical one not to miss. But it's on, the resources, as I mentioned. So it's critical here that in addition to the recognition, in addition to the right to land and to natural capital, they be given the resources. And as I have noted, flexible access to direct financing to enable decisions to be readily made and its implementation to be readily delivered. From the climate investment fund standpoint, we are banking on these lessons gained from implementation of the DGM since 2010. And of course, let me mention that the DGM model is implemented by the World Bank with about 12 countries benefiting from this program. The next level, of course, in terms of scaling up, in terms of expanding this opportunity, the CIF's new program called the Nature, People and Climate program, which was launched recently in June during the Stockholm Plus 50 event, has identified the DGM model as one of 4 financing modalities. That means from the Climate Investment Fund side, we're scaling up that program. But it's also critical to note that given the space, not just within the forest sector, but given that flexibility for that innovation to be identified and used in other sectors that are critical for climate action. So I hope the angle from which I have come, particularly in this conversation, gives you some food for thought in terms of enhancing more inclusive spaces for climate action, promoting partnerships, reducing the complexities in terms of climate action delivery, but also providing such platforms for continued cross-fertilization of ideas. And I think one last point that Lorenzo made was during the COP26, the pledges that were made around support to indigenous people and local communities, if I'm not overly narrowing that conversation, but owing to the value add of the IPLC role, some 1.7 billion pledges, dollars in terms of pledges were made. It will be quite expedient for such mechanisms, such financing mechanisms that have been found, tested, that have been, again, engineered by indigenous people and local communities themselves to be further scaled up, to be further used in ensuring that available such pledges can readily be released to enable their opportunities to scale up, mainstreaming their efforts into the broader climate solution. So let me stop here, but I hope to also hear more from the participants and from fellow speakers. So thank you very much, and Ben, over to you.
Thank you, Dora. So again, a couple of quick points of information, and then we'll, yes, okay, just over there.
Hi, it's Tillis here from IIED, and thanks very much, Dora. That was great to hear your presentation and hear about the direct grant mechanism. We had an IPLC panel session this morning, and one of the issues that was raised at that was the lack of direct finance that goes to IPLCs. So I just wondered if you could just elaborate a little bit more with some practical examples as to exactly how IPLC groups can go about, what steps do they actually need to go through to access the funding? Is it limited to a certain number of countries? Do they have to go through particular processes? My colleague here, Dismas from Tanzania, represents an IPLC group, and I'm sure he'd be really interested to find out how practically they would access the funding. So yeah, just a few more practical insights and specific examples would be brilliant. Thank you.
Dora, do you want to respond to that straight away?
Yes, so thank you so much for that question. As I tried to allude at the beginning of the 4 programs within the CIF, the Sustainable Forest Management Program was one, which is the Forest Investment Program. And within that 766 million, that 80 million was carved out to be able to enhance that direct access mechanism. So the idea here was that alongside the 23 countries that were benefiting from the Forest Investment Program, 12 countries were able to access, 12 countries with the DGM, or should I say indigenous people and local communities, were able to access these funds to be able to lead their own prioritization and implementation of activities on the ground. To give you a pretty practical example, let me just say in Peru, as one of the focus of the IPLC group was on land tenure and security. And here, as you would bear with me, the whole idea is to be able to have legal rights and legal access to their land, to be able to adopt much more longer term sustainable forest management practices as opposed to shorter term interventions when it comes to even promoting the planting of indigenous tree species, of course, that require much more lengthier times for maturity and for that matter for productivity. So here, indigenous people and local communities, aside the funds that were provided for the forest investment program, were able to push the space for enhancing registration of your local lands, of their native lands, to enable them to secure, one, their access, and then to be able to have much more meaningful, long-term tractable interventions in these spaces. So that's just one quick example. In other countries, for example, if I may give example from Ghana, where the focus is on local communities being able to access resources to promote agroforestry-based interventions on the fringes of forest. They were able to improve training. They were able to improve access to resources that enabled that whole intervention of reducing pressure on the natural forest assets to take strong grounding. In countries like Brazil, in Cote d'Ivoire, in Congo R, just to name a few, in Indonesia, programs have been designed tailored to the specific needs of the communities to be able to, one, improve management of these forest assets, and two, to enhance their livelihoods in a long term. So let me hopefully stop here, but I'll be very, very interested in hearing more if you have other questions to complement this. But the ultimate point, as I mentioned earlier, one was to have these funds available to complement the, should I say, the mainstream sustainable forest management, to give the leadership and the decision-making capacity to indigenous people and local communities to further complement the interventions that were going on within the forest investment program. Thank you.
Great, thank you, Dora. Another quick point of information, the last one, super quick.
Thank you. Andrew Jayaraja from Numurko. So as a company, we've been involved in the carbon and voluntary carbon markets for about 10 years. So I wanted to try and wrap together and comment on some of the things that the different speakers have raised. The biggest issue or one of the bigger issues we see at the moment is around corresponding adjustments and how the unknown quantity that presents when you're contracting on these units. And I think Lorenzo mentioned the point about supply and demand imbalances. We don't really see that from a volume point of view, but more from there's a misnomer around vintages. So buyers tending to want newer vintages and sellers being left with an inventory of older vintages that are still very worthy credits. But the perception that something newer is of greater benefit than something that's merely a couple of years older seems to be a factor that stops those contracts from completing. And on the notion of risk, I think...
Question, sorry, could you get...
Sure, and to what your last speaker mentioned, the partnership angle seems to be the best way to deal with that. We're looking at unit contingent contracting, because otherwise, without that, you're likely left with the political uncertainties of contracts failing under a force majeure event, which no one wants. So it's really to wrap those up, really.
Okay, so not a question. Okay, fine. All right, we are going to go into some discussion now, and we don't have a huge amount of time. So there are two related questions I want to ask. So one is for Abyd in the first instance, and then the next one I think is for Lorenzo. So the first one is a simple question, but a really important one, because we use these terms interchangeably, and that results in a huge amount of confusion. So what is the difference between funding a forest and financing a forest?
So, financing a forest, if you're providing finance, you're looking to earn a return. And that return is going to depend on what your cost of capital is. So if I can weave in the beginnings of an answer to the question that was raised here, if you're in the private sector, you might have a much higher cost of capital than if you're a philanthropic or public provider of capital. And so you need to have a risk-adjusted approach to that, to the capital that you're offering. In other words, you need to take into account the full range of possibilities that could occur, which would affect the returns. Funding is a different story. Funding is something that typically is associated with governments. Governments are providing funding, which could be in the form of grants, possibly some mechanism by which funds return back to the original state, but oftentimes it's grant-based.
And the funding is a necessary condition for the finance to flow, which is where the relationship exists, right? So so Lorenzo, and this is going to the de-risking question. So in your kind of enablers, barriers piece, you talked about, look, we need more government and philanthropic funding, and we need more concessionary finance. And so some people might argue, and I think this was the point that was being made before, was, so you're an asset manager, you're trying to make commercial returns. Why should government and philanthropy support you on both sides? Why should they fund the thing and provide you with concessional finance so you can make as much money as possible?
Yeah, it's a good question. So I think of it in maybe two angles, right? I mean, if you look at what motivated, in this case, when we talked about the example of Mato Grosso, there was the Germans and in the Norwegians being the largest bilateral funders for ecosystem services in the world. They realized, being Norway, there's just nowhere near enough money for them to actually address the scale of the challenge, and that the costs of inaction are so enormous that they have to find ways of mobilizing the private sector. So that, to me, in a way, is just a pragmatic answer to it. I mean, there's all kinds of philosophical questions you may come up with as to whether or not that's a fair, distribution of the risks. But there is a role that government has always played in addressing market failures, in making sure that public goods are met. Just as they pay for the arts, they will also pay for these kinds of things. So I think there's, as I see it, more of the pragmatic angle there. And look, I don't think it's as much a matter of investors coming into this space making rapacious returns, certainly not at scale. The reputational risks of that would be so enormous that it's not a matter of going in and seeing how you can, there's going to be easier ways to make money than putting your money to work to address, the biodiversity and climate crisis through NbS. No doubt about it, every investor knows that. Now, there are cowboys out there, have found ways to move quickly and making a lot of money, and certainly that's going to be the case. But if you're looking at a well-established insurance company that will, from their, long-term liabilities perspective, have a real interest in seeing the climate crisis addressed, have the capital, they want to make a fair return that reflects the risks and the opportunity cost, back to Abyd's point, that they have versus others. That's what we need to meet. And so that's the challenge that we're having, as opposed to it being, a matter of, rapacious returns. If I understood correctly, then there's the question of the funding versus the kind of credit enhancement. Shortly, I think there's just certain things in the capital or in the investment cycle that cannot be financed. They're not bankable. It's just too early. The risks are too high. That happens across the board. So there's always going to be a certain amount of money that, if you're a project developer, and you've got a lot of money and you're a real estate developer, you will put some of your own capital to work to develop the project. In these cases, that money is not available. The project developers don't have that. So you need to address that somehow, and it's not fair to ask a pension fund, frankly, is also managing the money of pensioners, to be putting that money into something that in all other circumstances is never covered by the investor. And then I think that the key to getting the financing, blended finance mix, is you've got to think, what is a fair use of, of return, of the social benefit, and who should be taking on which kinds of risks. I think Abyd had a fantastic point around the use of guarantees. That's an amazing mechanism, could be massively scaled up. The big issue is, it makes a big difference if you're investing, say, in a developing country, you've got the UK government or the US government offering a credit guarantee. That is not just the financial impact that it has, but it's also, you know, the halo effect of having those kinds of investors behind you, which makes a difference.
I'm more sympathetic to your view than the question might have suggested. But Rhian-Mari, you wanted to come in on the de-risking point, so.
I did. I just want to build on what I think was an excellent answer from Lorenzo. I agreed with everything he said, apart from the first statement, which is, I think this is a good question. I don't think it is. I think it's looking at the question the wrong way, in that wherever we see public money being used to deliver public goods and being deployed as a grant, where it could be used as a guarantee to crowd in multiples of private capital, it is not just a missed opportunity, it is a mismanagement of finance. Some of these guarantee structures can leverage public money by 10 times or more. And so if we're actually looking at how do we create the maximum impact for public capital in delivering social, environmental development goals, it shouldn't be allowed that we use that money as grants if there is ever an opportunity that it could be used as a guarantee to crowd in more funding. That isn't always the case, but where those cases exist, we should be forensic about them and we should make them happen. And the second point is, when these things are structured well, particularly guarantees, and by guarantees we can have revenue guarantees, first loss guarantees, we can also have, you know, I would also include things like contracts for difference as a form of guarantee, because what you're actually doing is guarantee a sort of a minimum price so that investors can get confidence about cash flows. When they're structured well, over time, what they've done is pump prime the market. They've created an opportunity for a new asset class, or familiarized the private sector with a new technology or a new nature-based solution or a new way of investing. And over time, they can be removed. So they're creating new markets. So again, this is about efficient use of public capital. And I think now is such the time to be having this conversation, when we've had 450 or more financial institutions signed up to the Glasgow Financial Agreement on net zero, increasingly focusing on nature-based solutions, wanting to deploy their capital away from some of the high carbon, non-nature positive investments of the past, but failing to do so because they don't see enough bankable projects and they don't see a new asset class being developed at pace. This is a huge opportunity for us, and I think we need to turn that question on its head.
Thank you, Rhian-Mari. I think some people would debate whether those things are interchangeable. I would myself, I must admit. But we can, if you were here, we could debate this over drinks. There was a question right at the back, and so we'll get a batch. Gentleman right at the back, lady just there. Do two at a time.
Thank you. David Donnelly from WWF UK. It's a question which goes back to Lorenzo's comment about the lack of credit enhancement. And I was wondering, do you have a view on whether there's scope for the corporates upstream in the supply chain to provide bankable offtake agreements in respect of the non-carbon benefits? Rather analogous to what corporate power purchase agreements do for renewables, where there's a significant ability there to kind of raise finance on the back of those bankable offtake agreements.
And if we could use that as a hook as well to explore maybe insetting as well. But let's take this other question whilst people are mulling.
Thanks. I'll be quick. Rhian-Mari, back to your question about the challenge of getting all the different pieces in place. I'm just wondering, who do you think the aggregators should be? Who should be the people, who are the actors who should be doing the blending of the finance, the aggregation and the benefits flows? Which actor is that? Is it the private, the public, or somebody else?
Okay, so Rhian-Mari, do you want to go first? And then we'll bring in the other panelists.
Sure. I think in the UK we have a particular challenge about finding that aggregation group, because we don't have a development finance institution per se. And so that is the obvious home where we see, and particularly going back to this point about guarantees, you know, there are really only three organizations, the USDFC, the USAID and CEDA in Sweden, that really use guarantees as part of blended finance structure as a matter of course, and do so a lot. And So when we don't have that kind of organisation at the moment, we've got a gap in our public finance architecture, and I would argue that would be the most sensible place to act as an aggregator.
Okay, Dora, do you want to respond to any of those questions? Was that a yes or a no? Sorry.
No, I was saying, please proceed. I was quite intrigued by the question on who does the aggregation, and I think I'll side with Rhian-Mari's response. It's just from the standpoint of the SIF, the interest in ensuring that the funds provided, the highly concessional funds are provided to enable that space of de-risking what may have been called too risky investment, but that have pluses, a significant contribution to climate solutions. So I believe I'm kind of playing the response in my mind, but I think the ultimate goal here is well-targeted, well-structured de-risking financing is always critical to unlocking new markets when it comes to breaking through and creating new opportunities for much more cost-effective down-the-line type climate solutions.
So role of corporate demand, how might that change over time, and what role might it ultimately play? Abyd and then Lorenzo.
Yeah, I think it has a really important role to play. The PPA model for renewable energy was mentioned. Going back to the compliance carbon credit market, we saw so-called ERPAs, being used very widely, emission reduction purchase agreements, the stream of value coming from future carbon credits. Obviously, you have to have a market that's operating at scale so that there's visibility on the price and a future curve, and financial institutions will then look at the volumes and value traded in the market and say this is something against which we can provide financing. And the same would be true for payment for ecosystems markets as well.
Yeah, I would agree with that. And there's always the opportunity for off-taking agreements, say, for commodities, right, that have been produced through regenerative or more sustainable ways. The only caveat I would say to that is that large investments that are really transformative take time. And so those two elements, the scale and timing, limit the number of corporates that can really step up to do that. And the question that then often comes up is that they don't necessarily have visibility or can be making these liabilities that stand in the future, which is maybe back to the insetting point, which is one of them that I mentioned. I think it's enormously interesting to think about then ways of integrating this more into the kind of core business operations of corporates through their value chains. And I think that there's enormous opportunities for value creation there from an impact perspective, and also lots of dangerous potential mines that lie on that road for gaming the system as well. But I think that's a next big, in my view, wave of opportunities in this arena.
Thank you. So we had one question there and another there.
Hello, it's been a fascinating debate and session. My name is Karen Sudmeyer. I'm an independent consultant. And if you had a magic wand, what would be the knowledge product that you would like this group to develop for you?
Great question, thank you. And another question just here. Sorry, just the lady up front, sorry. Just.
Thank you. Thank you so much, Tara Mae Smith from NYU Stern and Extraterrestrial Projects. I am curious if the Sustainable Finance Disclosure Regulation or the taxonomy adverse effects for biodiversity is driving any more interest in nature-based solutions or ecological restoration, or if that's not really touching your sector at all.
The EU taxonomy that just had gas included in it, confirmed by the European Parliament today. Okay, who wants to answer any of those questions? Knowledge product, that's a great question. SFDR, taxonomy. Rhian-Mari?
I'm happy to jump in on the kind offer of a knowledge product. I think one thing, and I touched on it on my prepared remarks, in the UK, we currently don't have an assessment of the risks, the financial risks that are posed by continuing biodiversity loss. And therefore, I think that would be, somebody would like to work with us on that, we'd be absolutely delighted. And I think that, following in the work that the Dutch and the French governments have done, which have actually provided an estimate of what that risk looks like for the corporate and financial sector. It's one way of galvanizing action and really making this something that would hit the P&L.
Abyd?
Yeah, so, I referred to the TNFD in my remarks, and you'll all be aware that the TNFD is moving in the direction of having location-specific, metrics and indicators once we get to that point, which is different, obviously, from what happened in climate. So the question is, can we think of a product, and this is blue sky thinking, but is there a product which could provide some kind of, it would be something like an ecosystem integrity index, for specific areas, so that would track, the kind of holistic health of that particular ecosystem over time, giving, obviously, the large flows of capital a sense as to whether, what the kind of ongoing quality of that particular ecosystem is.
I thought we had one of those.
Do we?
Do we? Quickly, do you have an answer to that?
In the last session, I'd argue that eDNA potentially provide that. Yeah, I would argue that the eDNA, because using samples of environmental DNA, you can capture the whole ecosystem. And then, if you can, I suppose, get a fingerprint of what a healthy version of that ecosystem looks like, you can then see how far away from that you are.
So that's one option. Okay, so we're almost out of time. What I wanted to do very quickly was ask each of the panelists to answer the following question, which is, are they optimistic that we're going to get to $1 trillion a year in primary market transactions, real flows going into nature recovery? And if you could pick one thing to get us there, what would it be? So we'll go online first. So Rhian-Mari and then Dora, and then we'll go here.
I don't think it's beyond the realms of possibility or credibility that we get to $1 trillion. The opportunity is out there. And I think I've touched on one of the areas that gets me really excited, and that is about credit enhancement. And I think that's going to play an absolutely key role in us galvanizing capital from both the public and the private sector towards the outcomes that we so desperately need to see.
Thank you, Rhian-Mari. Dora?
Very briefly, Ben, I would say that the CIFS, the Climate Investment Funds model, which is designed, again, working through the multilateral development banks to leverage both public and private financing. As I mentioned earlier, 10 billion versus 62 billion in public and private has really demonstrated that opportunity to de-risk climate investment has the potential to provide space for large scale scaling up investment that are found to be cost effective, that are found to be bankable over time. But I think one point that came out is that enhancing that space for inclusivity, that space for partnership is also critical, because that room for siloed solutions to climate is way past, and that ability to leverage different sources in a much more cost effective, should I say, market sensible way would be the way forward. And I hope that even within the small example that I gave on the dedicated grant mechanism, though it's a grant, has that opportunity to bring to the fore the role of IPLCs 1 and 2 to enhance that continued investment in them, in the sense that however small the resources, they have the potential to largely improve the adoption and use of nature-based solutions in an integral manner. So thank you, let me stop there.
Thank you, Dora. Lorenzo and then Abyd, 60 seconds each.
Depends on the time frame, but I hope for the sake of the world that we will get there in the shortest time frame. And if I had a magic wand, I'd love to see 4 to 5, if not 10 scalable business models that we can get to that trillion, that say, look, this is how you do it. We know, we have the recipe, and here it is. This is how you can replicate it across the full value chain of NbS opportunities.
So look, in the big scheme of things, $1 trillion actually isn't that much, right? There's 90 trillion in institutional investor, assets under management. They're looking for more positive things, more positive areas to deploy capital into. It's not going to happen straight away. I think the TNFD will be a catalyst, so it's probably going to be, an upward slope. In looking at what's going on in the blended finance, natural capital area, I think one of the most interesting areas to watch is probably coastal ecosystem investment. And I think, hopefully we'll see some really interesting things in that space.
Fantastic. Well, what a way to end. And thank you. Join me in thanking the panel for wonderful contributions. So I just wanted to close by saying just a couple of things. So one, I'm sure you've heard from Natalie and others about this new Leverhulme Centre for Nature Recovery that's being set up in Oxford at the moment. That's going to have a very significant finance track to it, so we'll be doing much more on finance and investment. If you're interested in being part of that in any way, please do reach out to me and some members of my team who are here in the room too. And of course, Natalie and others. And then the second thing is a little plug for something called the Public and Third Sector Academy for Sustainable Finance. So this is something that's funded by philanthropy, launched last year, and provides free or heavily subsidized training for those in the public and third sectors, central government, local government, NGOs of different kinds, the media, philanthropy, regulators, central banks, and so on. So if you are from any of those groups and you want to do a kind of an introduction to sustainable finance course for free, or if you're from an OECD country, it's heavily subsidized, like 500 quid or something, then Google it and apply, and we'll be doing a specific nature finance course as well, probably early next year or later this year, and participate, and we want to build a community around that. And this, I think, shows why it's really important for different bits of the community to speak about finance. Okay, so Natalie, over to you now, I think, and we better get off stage.
Okay, well, we've been on quite a journey today, I think, a journey that started and will end, in fact, with Amazonia. We travelled via, communities, women-led projects, restoration forest projects in Zambia. We went to the Yeda Valley in northern Tanzania, farmer seed networks in China, many other places, ended up in the Wyre Valley in the UK and the Highlands of Scotland, to which we'll be returning tomorrow. And many other places as well, and many other places and case studies have been, beautifully presented in our online poster sessions. So some of you might have tuned into that. Certainly the online Zoom community have been enjoying that. So we've been hearing a lot about the science and the practice and the policy around nature-based solutions. But today's been great, I think, because we've been getting a bit more granular, haven't we? A little bit more about closer to the front line of implementing nature-based solutions on the ground and all the challenges there are around respecting land tenure, land rights, about developing suitable flows of finance and so forth. We've been looking at nature-based solutions, in other words, from many different lenses. And I think, I'll just go. My wonderful team have been preparing these very brief and pithy takeaway messages from all the different sessions today, which is going to be quite good because some of them were parallel. Okay, so session 4. It's now no longer on this screen, but that's fine because I can read from these slides. I forgot my glasses today, so this is great that it's in big font. So we have lots of concerns raised around solutions, that nature-based solutions being viewed as a concept that has been designed around Western value systems, market-based mechanisms, and is now increasingly under private sector control. This is the perception that many grassroots organizations and traditional communities around the world can are voicing. And it's important that we hear those concerns. It's important that we call out projects that have these issues and ensure they're not being implemented and they're not being used in greenwashing. We need to move beyond this narrow lens on the economic value and material value of nature-based solutions. And we had very compelling talk from Mark Palahi, didn't we, at the very beginning of the day, about the importance of a circular or bio-circular economy. And we, talked again about how nature-based solutions should be designed and operationalized through a rights-based approach, not at the expense of indigenous lands, rights and livelihoods. livelihoods that involve people working with nature. So also in session 4, so session 4 was incredibly rich, wasn't it? Full of energy and colour and real world examples. So those in that session, we talked about how working with nature can help people better cope with crises, whether that's COVID-19, whether that's increasingly severe impacts of climate change, and that there needs to be a focus on locally led participatory approaches. So we had the example, a really interesting example from China on community seed banks. Knowledge and values rests across all people, but there is a lot of knowledge about how best to work with nature amongst Indigenous communities, and particularly amongst the women of Indigenous communities. But real challenges there in that many of those women, those communities don't have access to the sorts of finance that they need, no matter how small. It can often be very difficult for them to access it, even when it exists. And so we need technical and financial resources to ensure that rights-based approaches can actually materialise on the ground. So I'll come back to that in a bit, because we did touch on that, thankfully, towards the end of the last session. And yes, this is Stuart McGuinness's point. We need to be discerning about nature-based solution and call out projects when they're not nature-based solution, and call out greenwashing when we know it's happening. And it is happening. And it's a big problem for us, poisoning the well of nature-based solutions, as Stuart again said. In terms of, so there were first of the 2 parallel sessions. Session 5A was around ecosystem health and how do we ensure that nature-based solutions, whether implemented with an overarching goal for climate change mitigation and adaptation, or whatever it might be, food security, water security, how do we ensure that the ecosystems are themselves healthy? If they're not healthy, we don't get any benefits from nature. This requires holistic planning, proactive measures, and understanding the key trade-offs among the different aspects of biodiversity itself, as well as among the different ecosystem services, multiple benefits for nature. So scaling up nature-based solutions for adaptation, which is ecosystem-based adaptation, so that subset of nature-based solutions which is directed at really supporting adaptation, ideally adaptation as a process through time. And we need supporting balanced stakeholder engagement, so among the IPLCs on the one hand, but also business and the finance sector, as we referred back to in the last session, and a diversity of funding mechanisms. It's all about diversity, isn't it? We need biodiversity, we need diverse stakeholder groups, we need diverse cultural contexts, we need diverse funding mechanisms. In a rapidly warming world, diversity at all these levels is what we need to be able to deal with all the change that's coming, especially as most of it is very hard to predict. And then there was discussion around managing the complex trade-offs to promote biodiversity, social and climate outcome, and how this requires strategic, I think this is whole system thinking and land use frameworks. Okay. There was a great analysis, a global analysis showing the significant potential for scaling up nature-based solutions for mitigation, adaptation, biodiversity in the tropics. We know that, but there's been some really excellent recent work that Leon presented on the case in Southeast Asia, and also highlighting what is often overlooked, and that is blue carbon, carbon in our coastal and marine ecosystems. Enormous amounts of work there, both on the science and the practice side, of how we really harness the potential of nature within those ocean ecosystems. And I know that many of you here are really interested in that. I think there's some big, really challenging questions around that we should be talking about. There have been some great advances in monitoring impact. People worry about biodiversity. They think, oh, we can't do biodiversity because it's too hard. We can measure carbon, it's easy. And that's partly what's been going on. Partly, it's not the whole story. But biodiversity is perceived as being a really hard thing to measure, so maybe we won't do it. But actually, we do have Indigenous communities have lots of ways of measuring the biodiversity that they need. And we have from science as well, all sorts of new and emerging technologies that can help us measure biodiversity really quite comprehensively. And lots of really cutting edge research going on in this space here in Oxford and also in other universities across the world, looking at that relationship between those different measures of biodiversity. We had a deeper dive on the power of eDNA, which is just an incredibly exciting possibilities in the sense that it opens up, makes so much more practical that the challenge of trying to measure biodiversity at all different levels in the ecosystem, from the soil right through up into the different trophic levels and so forth. We can now do that more easily than we've ever been able to do before, and the technology is only going to get more and more economical and more accessible. Okay. So that was 5A. And 5B was a session in the Oxford Martin School, which I was extremely sorry. I really needed to be at least 2 people today. It's just generally the case, but today it felt the pain of not being able to go to the sessions in the Oxford Martin School. So there was one on governing nature-based solutions, how we foster inclusive and restorative land use governments. So there's a big theme here around global targets for biodiversity. And challenges and problems around having these global targets when everything that we really care about is super place-based, and how do you align those things? So global targets for biodiversity need to account for equity, otherwise they won't succeed. So this is sort of these are themes that have been drawn out across the board, aren't they? And setting targets through more inclusive participation is key. So working out, disaggregating those global targets into local targets that mean something to local communities, as well as mean something in terms of supporting the functional health of the ecosystem. There was a discussion about how we define equity. And in terms of equity, often people like myself, a natural scientist, I sort of throw this word equity around and realize it's as complicated as biodiversity, but at the very least, we need to think about recognitional, distributional, and procedural equity. So these different types of equity, and they all need to be taken into account and understood, which is why we need to be working across these different disciplines. Social scientists working very closely with natural scientists and anthropologists and everyone else to try and really make sure we've captured all these different types of equities and values. So distributional equity requires recognizing the presence of multiple values. So again, this theme of multiple values, the plurality of values of nature. Let's not reduce it to a single metric. And we needn't be afraid of the complexity. We can handle complex things these days. We really can. Designing an equitable decision-making process itself needs to be participatory. And equity, this is very important as well. When we think about nature-based solutions, it can often get simplified into, I hate to say it, but planting a tree. So you plant a tree and you walk away. It's a huge investment of time that goes over to build back an ecosystem. But in all stages of the design and the implementation and the monitoring of that ecosystem, you have to think about equity at all those different stages. Who gets the jobs? Who gets to be the stewards? Whose knowledge are we using? Who benefits from the carbon credits or the biodiversity credits or whatever it might be during that process? So that all needs thinking about. Understanding and overcoming obstacles was the session that just took place now. We're quite close to the end here, just the 2 sessions to very briefly summarize. So there it was discussed how critical it was to address the root causes of land and biodiversity degradation to provide an enabling context for nature-based solutions. Again, nature-based solutions, there's no silver bullet. And these are very deeply complex and political processes. Science plays a critical role to ensure that nature-based solutions deliver for people, nature, climate, and why. So in terms of assessing climate risk, we do need scientific tools and technology to be able to assess those sorts of risk. Contextualize, obviously, with regards to the local social and political contexts. Offsets need to be used in line with the mitigation hierarchy. This is very important to recall. And in fact, we can think of nature-based solutions within the context, and we should indeed think about nature-based solutions within the context of the mitigation hierarchy, avoiding damage being the most important, but often the most overlooked aspect of this. And generating quality offsets requires paying attention to the local context, including relationships between stakeholders and the policy context. So lots of common themes across all these sessions. I feel like we're starting to figure things out here. And finally, a very rich discussion with some diverse views, which is what we want. Because when we get to finance, things start getting quite tense, don't they? So it's good to have these very honest discussions, and I hope that some of the ideas and issues that were raised just in the previous section we can continue to discuss over drinks. So the realities are there is a significant funding gap remains. I mean, I've seen various figures. The number seems to go up every time I look at it, and I think this is absolutely right. Between 600 to 800 billion US dollars a year is needed for nature recovery, but you know, where is that funding coming from? We need jurisdictional approaches to things like REDD. This may help generate carbon credits at scale. We need to verify them and better ensure social safeguards. So that, if you think back to, if you were here for the session yesterday, session 3 on the importance of getting the monitoring and verification systems working and the technology needed for that. And that's critically important. Overarching constraints and unlocking private finance remain. In particular, was highlighted in the talks just now, the lack of capacity to ensure social safeguards materialize on the ground. That was something that really needs to be fixed. And also issues around risk. But risks are getting more and more intense, aren't they? And actually, we can't ignore nature-related risk. And regulation and policy are critical to shore up private finance. Okay. We need blended public finance, can help channel private finance sector given the lack of appetite for risk-taking by investors. We need to clarify, well, yes, this term nature positive is now being bandied around. It's nature-based solutions. Now we've got nature positive. We need to really figure out what we mean by that. I feel quite strongly about that issue. And this has been a common theme for a while, but it's really important to highlight it. We need this pipeline of bankable projects to generate these positive outcomes for local people, biodiversity, and carbon. And we heard about some of these initiatives, and I feel there are quite a lot of us now trying to collate what, lots of examples from around the world about what good nature-based solutions look like. So we need more clarity on nature-related dependencies and risks for the finance sector. Need to recognise, as we keep saying, the critical role of IPLCs and their values and rights. And we need a very flexible, culturally appropriate forms and flows of finance to ensure that the very best, most ethical sorts of finance reach the people and the projects that need them most. That is quite enough from me. Thank you very much for listening. This is an overview of what's happening tomorrow. Please try and get here for 9. I'm going to give a quick overview of the day tomorrow, and then we'll have a really interesting, really great keynote, I anticipate, from Professor Ed Barbier, who's joining us to talk about the economics of nature-based solutions. We have parallel sessions again tomorrow, so don't forget to book if you want to go to the ones in the Oxford Martin School. And we're going to attempt a group photo sometime over the next 24 hours, possibly tonight, possibly tomorrow morning. So keep your ears peeled for news about how we're going to do that. We'll probably put it on the Telegram as well. Have a wonderful evening. I hope you've had a great day, and I look forward to seeing you tomorrow.